What's up, family? Welcome back to yet another valuable video over here at Skilled FX Academy. And of course, today we have part two of the full smart money breakdown course. And I'm just going to get through various topics that we're going to cover in part two. We are going to have part three. I have realized that this is not just a concept that I can just cover within a few videos. So part three is coming up to cover a little bit more of the complex and advanced things. But in this video, we're going to be covering trend validation. We're also going to cover understanding BOS, so breaks of structure, or valid breaks of structure, as well as valid change of character, referred to as a chalk in smart money concepts, as well as the correct way of spotting supply and demand. Okay, using as well a Fibonacci for discount and premium markets. So that's what we're going to be covering in this video. Please note to our first time viewers, how I teach is that I'm going to cover the concept by drawing. Once we've laid that foundation, we move on to the actual live markets to really break it down for you and teach you in that way to further your understanding. If it's your first time watching, make sure to subscribe, like, and also share these videos with your friends and family and well acquaintance. Okay, let us just get in straight into business. Now, the first thing that I want you to really understand is a concept that we call market phases. I believe I did cover a little bit of it in our part one. If you're watching part two, please go to part one. It's a bit lengthy. I did try to kind of simplify this one that it shouldn't be as lengthy. So market phases, it's just understanding the movement of the market and the names thereof, but it's quite relevant to validating the trend. So whether we are in a bullish market or a bearish market, we have what we call an impulse, which is the actual movement of the trend. So if the trend is bearish, in this case, we have an impulse. If the trend was bullish, then that overall trend, there would be the impulse of that. Okay, so we have the impulse. As a market, we call it pullback and the impulse. Now, reason why this is important when we get to this sketch over here, this foundation that I've drawn for you just to understand a bit more, is that when we're talking about trend validation, we need a few things like change of character and chalk. So a change of character, or rather, let's start with a break of structure. A break of structure validates for us that we're still within that actual trend. So for example, here, it's still validating for us that we're still in this downtrend that you guys see over here. Okay, so this downtrend that we notice, what shall we look for when the market is giving us pullbacks, when it's giving us the impulse? It should break this market structures over here. We have lower lows, as you can see. We've got lower lows over here. And of course, we also have lower highs. I believe I've taught that in the first class thereof. So what the market has to do to validate a trend for us, to let us know that we're still within that actual trend, is that it has to break the previous lower low as it's creating a new impulse. So as you can see, I did put B. You label it as B, or you can label it as BOS, standing for break of structure. I just like my chart a little bit much neater and quite minimalistic. So B, it's good enough for me. So that just shows you and the person who's watching your chart that you're referring to, marking that as that the market has broken, and it's telling you that as it pulls back, it's gonna create a lower high, therefore resulting into new lower lows. I hope you do understand that. Okay, I hope you do understand that. Now, that validates a downtrend. And of course, how do we now know that a downtrend has been exhausted thereof of validating that we're still in a downtrend or just even a bullish market? That's where we have the concept of change of character. Now, a valid change of character. In fact, let me just cover what is a change of character, then we get into a valid change of character. Okay, so a valid one, or rather, a good change of character is that when we have a lower high, as you can see here, where we're still anticipating, okay, that the market is still going lower. As it pulls back, one may think this is an ordinary pullback, but that pullback, if it breaks the lower high, right? For example, if we see this pullback over here, okay, this pullback did not break this lower high. It did not break it. So that resulted in it being a new lower high, therefore also still validating to us that we're still going in a downtrend. I hope you guys understand that. But now when a pullback starts to break the previous lower high over here, that's what it did, then it becomes what we call a new higher high, as you can see here, breaking that lower high, resulting in a violation of the previous trend, which is now that bearish trend, and starting a new trend. That's how we know that that trend that was now being validated by a break of structure has now been violated, or being now birthed out to start a new trend through a change of character. That's why I do like smart money a lot, because of the clarity that it brings to especially beginners. Okay, you don't have to overcomplicate this in order to get quite good trading over here. Okay, so in this case, as you can see, once I've broken that, we now have higher highs, and as the market goes to create a lower high, we can a higher low, in this case, which is a bullish market, we can now see that we are now in a bullish market. And therefore, even the same way, the market will validate itself here through a break of structure, where as the market creates the impulse, creates a new higher high, okay, and of course pulls back and creates a new one. It's just simply validating for us with higher highs and higher lows, with breaking of structures, that we're still in a bullish market. And the same pattern will repeat itself. If the market were to have this higher high being broken, where the market would sell and break that higher low rather, then starts creating lower highs, then would be in a downtrend. Okay, that's simply how we validate a trend in respective of any time frame that you're using. Okay, of any time frame that you're using. On the first part one, I taught you a kind of like a breakdown of time frame, how to take the lower time frame, match it with a higher time frame, or using higher time frame structure to get lower time frame entries. Over here, I'm just covering the very essence of a structure. I did teach order flow in the first one. I did teach microstructure found in the lower time frame that correlates so much with the higher time frame, which is the order flow. Please do check that out, guys. So just to checklist, I've taught you trend validation, I've taught you change of character and BOS in terms of the importance of that. Now, just before going into the other topic there of correct supply and demand, let's deal with one thing over here, is to really niche down what is a correct change of character, because some of you guys can really be tricked by this, whereby the market can actually be using or breaking the previous lower high just as liquidity, and not to actually create a new change of character, where we've had markets where they've created something like this, where it will use this previous lower high in order to just actually sell the market instead of really creating a new higher high. So how do you not fall for that trap? How to differentiate? Well, a true change of character has to be having a break of structure. So as you can see here, we do have a lower low, and we have this break of structure that's telling us that the market was actually anticipated to go further south. But now something displaced that validation by breaking the lower high over here. So there has to be a displacement in the market for it to be a true change of character. If the market never gave you a previous lower low to be broken, then it will create a very much of a trap for a lot of traders. Let's go over here that I can show you this. Okay, let me throw it over here quickly, and you can get to understand this example that I mean. So let's say we're in a downtrend. Let me get to just put my mic here. Hope you guys will be able to hear me so I can clearly draw nicely over here. Okay, let's say we are in a downtrend. And then as we're in a downtrend, the market does something like this. Okay, then gets to break this, and then people call this breaking a change of character. No. And then you'll expect that as we're going over here and the market pulls back slightly, they'll be expecting, let's say, to buy at the demand over here. Guess what happens? That demand stops them out because the market was only retesting this level because this was a invalid change of character. If it was a valid change of character, then it should be that that whole movement must have broken a BOS, and that whole impulse must have facilitated the breaking of that lower low in order for it to be referred to as now a change of character. Okay, so it's a lot of attention that we need to pay to when we talking about change of characters. Otherwise, you'll find yourself at situations where you are part of the liquidity that the market has engineered. And we'll talk about liquidity and engineering liquidity, like inducement and sort of that within our part 3. Now I'm just laying more foundation for you to really understand how to operate and where about. Now, let's talk about correct, or rather finding correct supply and demand, because there's a correct way on how to do this and there's a really bad way, right? Now let's talk about the law of price action. The law of price action is derived from the very definition of price action, is that we use historical price action in order to predict future data or future price. In this case, that's what we want to use, right? As I said in my first class, part 1 over there, I spoke about in terms of really spotting, to say we want to buy low and sell high. And what it simply means is that we are targeting lower highs in order to sell high. We're targeting higher lows in order to buy low in a bullish market. It is better to buy in a bullish market rather than to buy in a bearish market, because you would be simply buying a pullback in a bearish market. So that's what I want to actually touch on today in terms of those supplies that we can expect the market to give us. For example, we can say buy smart money, right? We expect that every lower high can be what we call a demand in this case, or higher low in this case, can be a potential demand. But are you just going to be on your chart? I've seen some of my students, as they were still learning, when I was laying down the concept, to rush straight into applying, right? To mark every demand area on the chart. Are you going to be just waiting and looking, exactly waiting for the market to touch a demand area? No. There are particular ways to do that. And it ties down to exactly what I've just taught you now in terms of the validation of structure, and why I taught you this market phases right here. This market phases right here. Okay, let's go into this market phases. Let's say that is our supply over here. Let's delete this line. Let's say this is our supply, our market. I'll teach you how to mark all of this stuff. The market gave us a pullback, gave us an impulse. This impulse validated structure by violating the previous lower low. So, which is for us now, this point that we can see over here. That was the point that was violated to, in order to validate. A clear supply has to violate structure. If it does not, then it will not really even, the chances of it pulling back. And why I say chances, because there's a missing piece here to just you finding the right supply. Okay, then once it starts pulling back, the chances of it pulling back to that supply is very high in order to create a new lower high over here. Okay, a new lower high for us on that supply. And then of course one would sell here, and then stop loss above the zone, and take profit at the next structure over there. So that will be stop loss entry, take profit. I hope you do understand. But now there's a missing piece here that I want to really teach you, which is using the Fibonacci, using discount and premium markets helps you to really niche down the right zones for yourself in terms of knowing where to buy and sell correctly. But it has to firstly validate or violate that overall structure in order to say that impulse that you're waiting for the pullback, let's say you just, now the market is started to pull back. Let me just get something here to draw nicely, where the market has started to pull back and you're like not sure if it's going to touch that zone or what, or you're not sure there are other supplies over here, there are fair value gaps in there, you're not quite sure. Now you can use a Fibonacci, Fibo retracement. On your trading view, it's over here. Okay, I have marked it, but it's referred to as a Fibo retracement. It uses Math's laws in order to calculate retracements that happen on the market. I'll talk about it in some day. It's another topic, right? So let's just draw it over here. Now, it won't be customized like as you can see it. So let's go back into the actual default settings over here, how it will appear. It will appear as a very colorful thing on your chart, something of this sort. Okay, this is how it will appear. But now when you want to customize this, you can just simply double click this thing. Okay, and it will take you to style. When you get to style, I want you to sort of tick off some of these boxes so they shouldn't appear in terms of levels. Your 4, your 3, your 2, okay, and your 1, 6. You just simply want levels like from 1, which is 100, all the way to 0. So this levels that you see on my chart. Then if you want these things to be of the same color, or let's say, first of all, you want the background to be eliminated. So you shouldn't have this colorful rainbow stuff over here. That background, you can just simply tick it off and it will remove the background colors. If you want as well, that it shouldn't actually show the trend line, you can go ahead and take off the trend line. If you want this whole thing to sort of just give you, one color, for example, where you have one color, like it's like gray, everything is gray on that, or everything is sort of just black like that, then you can sort of just save it and say, okay. Then every time you now click it on your chart, it will appear as you customize it like this. Okay. There are various ways of using a Fibo, but in this case, we're just simply using it to identify levels in the markets. Now, let me take your attention. As you can see here, you place your Fibonacci from the tip of your impulse all the way at the bottom of your impulse. So from the peak to the low of your impulse, right? And as it pulls back in what we call this zones now over here. From your 100, now this is put downside because we're in a downside market or bearish market. From 1 all the way to 50 or 0.5 in this case, we call it premium markets. Okay, and then from 50 all the way to 0 over there, we call it discount markets. It's a D and a P. Okay, and of course from the 50, just the 50 alone, we call it equilibrium. So you can refer to that as an E, equilibrium. You don't have to draw the stuff, I'm just teaching you. Okay, so whenever the market comes into a place above 50, 61, 78, 100, this is what we call the premium, where the market can possibly use an opportunity to sell. Now, I like it when a supply is within a zone over here of some sort, or between a level. Let me just clear that up. Between a level. So we have 1 to 78. That's the extreme zones. from 78 to 61. That's the sweet spot. Most zones will turn around there instead of supply or all the way into the extreme. And of course, we do have more or less the break even here, or what we call the equilibrium zone. Okay, same thing happens over here. The market can actually buy from here, or we have the sweet spot where it can buy from, or we have the extreme zone where it can actually buy off. Now, the best ones are this two over here. Okay, the extreme and the sweet spot, as well as here where we can sell as the extreme and the sweet spot. That's where I like to spot my zones of supply. If a zone is within that area, for me, it's a high probability trade because I know for sure we are going into some money. Okay, and then any zone that tells me, for example, here that I should sell, usually I would not take it, except that it touches 50%, right? But if for example, you are right here, okay? You're right here where the market should actually sell, and it's giving you those signs. I wouldn't sell. I rather wait for the market to actually pull back fully into the premium. Then that's when I can be ready to sell. So that was one of the best ways in order to really spot correctly supply and demand using Fibonacci. Okay, now let's go into the actual markets. I know you guys want the juicy stuff, the liquidity and all of that. We're going to cover it in the third video. I'm sure this video is already quite lengthy. Now, let's go into structure over here. Just as we're about to go into structure, guys, I want to let you know, for those who want to speed up their learning process, okay, their learning process in terms of trading, and you want to speed it up under mentorship, we are celebrating 4 years of running Skilled FX Academy, formerly known as Prophetic Forex. Now, many of you have seen our services and might have found them a bit pricey for the value. So therefore, each and every year, we do reduce the price for you to get more value at a lesser price. It happens because it's the anniversary. So we've given you guys 60% off our advanced trading course as well as our mentorship Discord. So you enrolling for the advanced trading course gets you our mentorship Discord, where we hold your hand throughout your journey of trading through Zoom sessions, live sessions, trade setups from other students as well in the group, just an overall community that's going to nurture your growth in trading. If that is you, you must take advantage of the 60% off. I will put the coupon over here. I'll also put it in the comment section. This is only valid from the time you're seeing this video all the way to the 15th of October, 2024. Again, I want to say it's only valid till the 15th of October, 2024. So make sure you take advantage of that, or you can just DM us to ask us a little bit more questions about what it actually includes. Okay, now let's go into actual structure. Remember when I was teaching you on the first part one, I taught you order flow in terms of how we really niche down through smart money is by using structure and spotting, supplies in terms of base, rally, and drop, something of that sort, where we have a rally-based drop that really helps us. You go check it out when I talk about those things, okay? But let me just quickly cover it for you here. We're talking about how to really spot a valid or a good supply or demand. If it's a supply, for example, or if it's a demand, it will need to have a drop, base, so a congestion of price action, and a rally. And as the market pulls back into that, now we use that as a demand level together with what I just showed you now by the concept. Okay, I'm not drawing quite nicely, but you guys check it, and then the market uses that. If it's a supply, the market needs to have a rally, needs to have a base, needs to have a drop. And as the market pulls back, okay, now we can have the market pulling back into that and selling overall. Now, that's the very essence of it. And I don't want to cover a lot of what I covered in part one. You can just simply go check it out. But let's go over here now. We're going to use the higher time frame zone. I've been using just this zone for a lot of examples that I've been showing you. Okay, so we can spot now. We're gonna combine everything that I've just taught you in this video by concept. We can spot, okay, this is the demand level. Why can it be a valid demand level? Now, someone would answer, yes, the Fibonacci and all of that. But before you put the Fibonacci, why is this a valid demand level? Okay, let me just show you here over here. We do have what we call a break of structure over there. Okay, that break of structure, it is validating for us that we're actually still going higher in terms of trend breaking. Now, this very impulse that initiated that breaking of structure had a drop, base, and a rally. And that drop, base, rally, we stretch it across because it also facilitated, it's a higher low that the market created. And as the market pulled back into it, we can see that the market really left off and it's still going higher. But now, how would have one known that they shouldn't fall under the trap of taking maybe this demand level over here? There are various demand levels, or taking this demand level over here. How would have one known? Because as you can see, they did act like they respond to the demand level and the market broke further down and it got to this one. And I'm sure people were like, yeah, this is the actual demand level. And look at that. The market just responded slightly for scalpers and then dropped further. And then this was the actual move. So how would one avoid that? As I said, we use now a Fibonacci. This is where it comes in. Okay, this is where Fibonacci comes in. We draw it from the bottom of that trend all the way to the tip of that trend. Now, as you can see, our 1 is at the bottom there, our 0, because we are dealing with a bullish market. So you want to put 100 all the way there and then 0 all the way at the top. Now, let me just stretch it for those who are using phones. Okay, look at now this chart, how good it looks. Now, as you can see, remember when we spoke about discount and premium markets, from 50 all the way to here, we have the discount markets, which is a place to buy. From 50 all the way to 0, we have premium markets. And from 50, we have equilibrium. Now look at where some of the zones were in. So if you're marking over here, let me just erase this and actually draw valid zones for us. Okay, so look at this. This was a zone that many of the people could have confused for a demand. They could have marked it, and as the market was sort of just pulling back, look at where it was. It was in a premium market, so there's no way you're looking for buys in a premium market. That's why it's invalid. Now, you get over here, this one would have been a tricky one, although it responded, which was good, so you wouldn't be in a loss per se. But if you're holding, then it's a lossful trade. If you're scalping, this was going to be a profitable trade because it was exactly at 50%. Now, as I said, the sweet spot, or rather the extreme spot, is this one where we have high probability to trade with a sweet spot between 78 and 61, which is this area. And it came all the way into the extreme zone and sort of just bought from there and went higher. Now, let's talk about another place over here, or another zone, or another example, if I may put it that way, where we can actually see, let me just get something here, this impulse that was created due to that response of that zone. This impulse now really breaks off a change of character over here in terms of breaking the previous lower high of that trend. So it does validate for us. It can also be a change of character in this regard, although we don't have really a break of structure previously. So it's just simply a change of character. But as you can see, a break structure gives us higher highs as it pulls back. Look at where it's pulling back to. So as it pulls back, because it broke structure, we can now simply just draw the Fibonacci on it. Okay, look at where it comes in now. Just the example I showed you about the sweet spot. I only take buys from there. If I'm not desperate and I just stick to my rules, look at where this buy came in. It came in all the way into the sweet spot, into this place where we have 61 with 78. It didn't go all the way to the extreme zone part. Now, let's go to the 4H. You will see better now the zone that it actually used over here. Now, there was a demand level. Now, this demand level, as you can see, it became relevant because it was in the sweet spot of the market. Therefore, I would have taken this trade, not confusing it. So instead of marking every demand over here, imagine marking all the demands of this trend, stretching them across over there, stretching them across. Instead of marking every demand, rather mark the demands that are within the extreme and the sweet spot. And as you can see, the market came back into the sweet spot and then rallied all the way up. And that's how we have this actual zone, right? This impulse that we have right now. Okay, I hope it does make sense to really help you to really spot and validate trends, to really make sure that you're trading with the right supply and demands within the markets. Now, that's it for this video. We're going to go into a more detailed video in part 3. So if you have just tuned in or you just found us on YouTube, this is how we teach. We take our time to really lay down the concepts that even if you're a beginner or complete like intermediate trader or advanced trader, it's still quite relevant for you to pick up the basics and really use them. Watching this is not enough. It doesn't do justice. It can only be just knowledge to you. You want to go back to your chart and try to do the same things as I was doing. Doesn't necessarily have to be on NASDAQ, can be on any other pair currency or crypto, whatever it can be. This plays out to the T. So go play on the chart and see what you come up with. It's really going to help you so much. Anyway, thank you so much for watching this video. I'm quite sorry it's so long, but yeah, please as well, I do suggest that you watch part 1 that you're probably now seeing on your screens. Do watch part 1 and then come back to part 2. God bless you. See you on part 3.